purchases, and one of the reasons might be to provide some form of stock option or portion of executive compensation or employee stock ownership plans as a method of incentivizing employees. That is really the topic of this particular deck. And as you can see here, what we are talking about is the fact that companies can use a range of different types of stock-based compensation plans to do a couple of primary things: to create incentives for employees to act like owners, or to encourage employee retention and longevity. One of the great complaints of medium-sized businesses is from the owners, why can't I get my employees to think and act more like owners? And the obvious and simple explanation is because they're not owners. They're not going to take it with as much vested passion as you are as the owner. And therefore, the part of the remedy to this is, well, let's make them owners so that they feel the incentive of, if the company does well, I do well personally, financially, right? And that is, as we return to the slide, that is really what we're talking about in terms of creating incentives for employees to act like shareholders, is to make them shareholders. So the amount of the stock award is often tied to some metric of company performance, which might be, say, sales revenue, net income, stock price, and as you might guess, each one of those metrics, from a positive perspective, if the employee or manager in question has some direct influence over that number, it really could be an incentive to increase their contribution of performance in order to raise that metric. And of course, part of the argument is that depending on how you use that metric and which metric you assign, it is possible for people to get into rather short-term thinking, only thinking about their compensation rather than the long-term effects and influence on a company of somehow perhaps manipulating the particular number that your stock award is tied to. That is, in many cases, a topic for another lecture and another course on business ethics, but we might as well mention it here. You can also see that, at least in theory, the concept is stock-based compensation motivates employees to work harder, and that you hope will make decisions that improve company performance, not only over the short term, but over the long term as well. Now, another large reason is that depending on how you structure your stock-based comp plan, you may have a relatively long time before employees can actually exercise their options to purchase the stock or otherwise tie it to a period of retention and longevity, which provides a concrete and economic incentive for employees not to jump ship and to stay with the company over the relatively long term. So those are the reasons why many companies will use some form of stock-based compensation, and in some cases make a substantial portion of an executive's comp based upon stock performance. So you can see here there's a couple of issues from an analysis perspective. One is, when do we recognize the expense? What is the expense amount that we actually recognize as compensation? And then, of course, if we're talking about awarding stock, then aren't we also talking about diluting the pool of common shares with simply more stock outstanding, which will have a potentially negative effect upon every other current shareholder by having simply more shares out there issued. So you can see there, we are attempting to estimate the fair value of the award, essentially as the gap principle, right? And recognizing this fair value as a compensation expense in the period in which the employee provides service. Accounting for this, then, you can see here the common accounting steps here. When the award is granted to employees, the company estimates the fair value of the award. And part of the mechanics of that we will see in another slide. There are a number of models and frameworks that companies and accounting firms may use to estimate that fair value of the award. The fair value of the award is recorded as an expense in the income statement, ratably over the vesting period, while when the shares are finally issued, common stock and additional paid-in capital increase in the same manner as simply a cash-based stock issuance. So reporting this kind of compensation, you can see here, part of the trick of this is that it is rarely reported as a separate line item. However, we can sort of extrapolate and determine the amount of the expense from the statement of cash flows. Notice we are not talking about the income statement. We're talking about this third statement, or fourth, depending how you're counting it, right? Another one of the four primary financial statements, statement of cash flows. You can see how that is reported there. Johnson & Johnson adds back in 1138 of stock-based comp expense, which is included in computing net income on the income statement. So this is sort of similar to the non-cash, if you will, depreciation add back that we typically will see as sort of analogy. So then really the core question becomes, is stock-based compensation a cash expense? Is it really? Because in some cases, the add back might lead some to conclude this compensation, like depreciation, is cash free. It's really not a flow of cash. However, you got to remember, this stock that's going to get granted comes from someplace, and if the company buys new treasury shares in the open market in order to accumulate the shares necessary, then you really do have a real cash cost if they're purchasing shares to offset the potential dilution of the share award. So in order to accurately evaluate and forecast operating cash flows, which is really the core evaluation of a company, then analysts have to do one of two things. Either have to include stock-based compensation expense, or they have to recognize the related treasury stock purchase as a true cash outflow, as an operating cash outflow, because it's part of compensation. You can see that there's a couple things that need to be disclosed. Here's one of them. You have to disclose in the financial statement notes at least two things. One is the activity, the plan activity, which will include what are the number of shares granted, what are the number of shares issued, and if there are any shares forfeited. And that would be essentially when employees do not stay long enough to complete their vesting period, perhaps, or they fail to exercise their options within a specified time period. There are a couple of reasons why shares that are granted as part of a compensation plan don't actually end up getting issued. And then the second primary thing besides the actual details of the plan activity is this fair value and the expense thereof. And so you can see here, as we'd mentioned before, right, the fair value is what ends up getting reported in financial statements, and stock option plans will need to be valued using some sort of a GAAP-approved model like Black-Scholes or Lattice model, also known as the bilateral model. These are outside of the scope of this class in terms of actually detailing how those models work. Just realize there are rather complex models that are used to evaluate this, and that means that there is some amount of estimation and therefore perhaps manipulation of the model in order to manage your earnings. It is an area that needs to be watched pretty closely. And once you've done that, it shows up as an expense on the income statement. The value of the shares over and above the price the employee paid for shares is the difference called the intrinsic value, right? And so essentially, right, you can sort of see there how this worked out for J&J at the end of 2022. The important stuff I think that you want to recognize when we talk about stock-based compensation is that there is a difference between expense recognition and the reality of cash flow. It is a temptation to look at the way that stock-based compensation is reported as a non-cash expense, but the economic cost can be very, very real and very costly to avoid dilution by purchasing back treasury stock. Because of that future potential dilution, stock-based comp is really a trade-off. It's a trade-off between, well, how do you incentivize your management, especially your senior executives, and preserve long-term shareholder value at the same time? And so it is this real trade-off that many times the only answer becomes an actual economic cost to offset the dilution by purchasing back treasury shares, as we just mentioned. All right, and then finally, this notion of fair value measurement of the plan by some of these modeling methods is an opportunity for earnings quote unquote management, right? And therefore you need to study the disclosures closely to really see over time what is the reporting. Does the reporting seem reasonable? Does the inputs to the model seem reasonable in order to really assign a fair value to this aspect of compensation? I hope this is helpful. There's more in the textbook on this, of course. We will see you in the next video.